Welcome, my name is Vincent Luce with Forex Trading Institute. Please take a couple minutes and go over the following risk disclosure. Lesson number 11, Trading Pennants. Trading should be fun. Learning the rules of trading and obeying them is where the freedom is found. You're going to see that this business can give you a lot of financial freedom, a lot of free time, but you got to follow the rules. If not, it's not going to be an enjoyable business. Now, we're going to go over pennants in this lesson. And a pennant's a form of consolidation. Look how it looks like a pennant. That's why we call it a pennant. Okay? And it's a form of consolidation, moving sideways. And it usually occurs after a large move. The market goes sideways. Now, the financial markets vibrate as they move. The dissipation of that vibration is called a pennant. And we could see here the market moved. There was a big wave, and then the market started going sideways. Now, pennants, are a form of consolidation. They usually form after there has been a big fundamental announcement or a large breakout. They can also form right before a fundamental announcement. They're considered a form of consolidation. Pennants may form when prices have reached the values that traders are not willing to pay, or not more or not less. And pennants may form when traders are not trading and waiting for a fundamental announcement. When traders spot a pennant, which is a form of consolidation, you got to anticipate a breakout. And remember, a breakout is when prices break out of a sideways pattern or a pennant. Remember, accumulation and a breakthrough, either lines of support and resistance. If the bulls are going to take control of the market, they're going to break it to the north. If the bears are going to take control of the market, they're going to break it south. Now, when prices break out of the pennant, they start trading in a channel. Okay? And look how the market went. It was in a channel, and they could either break north or south. Everything to the north of these lines is going to be the buy zone. Everything through the south is going to be through the sell zone. And we traded exactly the same way, the rules of the buy and the sell zone. And we could see it here. Look how the market had a large break up. Then the market went sideways. Okay, after this large swing, it got into consolidation, into a form of a pennant. And then it broke out north again. And then it went in consolidation again. And then it broke out north again. You're going to be surprised how many times you find pennants in the market. Now, there are different types and different shapes to the pennants. You're going to see flagpole pennants, ascending triangle pennants, descending triangle pennants, diamond pennants. And the rules to trading these pennants are all the same. Now, flagpole pennant, the market is moving in a Fibonacci sequence. It's doing its A, B, and then we're finding a pullback on a Fibonacci. And it's making, you see here, equal lines as going down of resistance and then up lines of support. And they're bouncing off support, resistance, support, resistance, support, resistance before it breaks out. And these flagpole pennants have a 90% probability of breaking to the north. Obviously, there's always that 10% it could break to the south, but if we're playing probabilities, the higher probability that it breaks to the north, or the direction of the trend. In this example, we're looking at an uptrend, so it breaks in the direction of the trend. If it was a downward pennant, it will break south. It always breaks in the direction of the previous trend. That's why we want to look at our daily and our 4-hour charts and 60-minute charts to look at the direction of the trend. And we could see here a flagpole pennant. Okay, the market went sideways, and then it started hitting off support, resistance, until it broke. It did the breakout. Here was the full bearish bullish candle in the buy zone. That would have been your signal to buy, and we had a nice rally from that point. Now, an ascending pennant, the market is creating equal levels of resistance. Look how it's doing equal levels of resistance. But the lows are ascending. And look how the lows here are ascending. And these pennants usually break to the north because they're ascending. They have more pressure up to the north. Now, the market creates equal levels of resistance. You can see here, equal levels of resistance. And then it's ascending, okay, lows. And the market usually breaks to the north. We always have to follow the rules. Wait for that full bullish candle. Here for that full bullish candle to get in. because we don't want to anticipate ourselves. We got to follow and be disciplined, because sometimes I see traders saying, "Oh, this is forming an ascending pennant. We're going to buy," and then it breaks the opposite way for just not being patient. You got to follow the rules. Because look at here, an ascending pennant, and it broke to the south. Okay, so it's very important. The market creates equal levels of resistance. The lows of support are ascending. This was an ascending pennant. The market usually breaks to the north, but nothing in the market is 100%. That's why we got to follow the rules. We never got a signal to buy. Look, it went out here, and it didn't give us the full bullish candles. It pulled back in. And here we never had a full bullish candle above, and then it pulled back in. And here we had the bearish candle. That would have been our signal to get in short. That's why you see being disciplined played off in this situation. Descending pennants. They're making the market creates equal levels of support, and the highs are descending. Look how these highs are descending, and the market usually breaks to the south. Okay, it has a higher probability to break into the south. Look at here, equal levels of support, and then the market broke to the south. A diamond pennant, the market expands first and then contracts, and this can break either north or south. There's no, neither one has a higher probability, and these are very rare. That's the reason they call it the diamond. And on top of having a diamond shape, they're also rare, just like diamonds, in the market. And you see how it expands and then contracts. It's very rare to see this happen in the market, but it could happen. And we see it here, for example. This is a clear example where the market was expanding, and then it contracted, and it broke this trend line, and this would have been our sell signal, this bearish candle, to go short. You want to review this in your workbook. Now, rules to trading the pennants in the buy and sell zones. You always have to find the inner, outer, and trend lines. This will help determine if we're in an uptrend or a downtrend. Remember, usually that it's going to help us predict in which direction the pennant's going to break out. You draw your pennant lines and determine which type of pennant you have. To know the higher probability, it has a probability of breaking to the north or the south. We find the buy and sell zone, and then find the backside of the trend line, the potential resistance of support and the breakout. And you always have to have that if-then approach. If it breaks to the north, here's where I'm going to put my entry point. Here's where I'm going to put my stop. If it breaks to the south, where am I going to put my support and my stop and my limit? Okay, so if we go back here, if this breaks to the south, okay, we enter short, and at the last high, 10 pips above, we're going to put our stop loss above the high, the last high of the pennant. Now, you're going to see sometimes the market comes back and it tests the backside of that pennant, but we have to have an approach. Now we say, okay, if it breaks to the north, where's the last low? Here would be the last low. 10 pips below, we're going to put our buy, our stop loss, and we're going to go to the north. So you always have to have that if-then approach situation, and we always want to find our last A, B, C, Ds and determine where it's going to be an exit for profit. I can't stress enough. Sometimes traders know when to get in, but they don't know when to get out. It's just as important to know when to get out and take your profit, because you haven't made anything until you haven't taken that profit and hit that D extension. And remember, if it's over 50 pips or over the 5%, sometimes you're going to be able to go over that. You might be able to go 100, 150 pips as long as it's under that 5% rule. If it doesn't meet that equity management of the 5% or 50 pip rule, then you just have to stay out of that trade. You pull out your trader checklist and you create a trading plan. Okay, the rules. The first rule to buy, it has to have a full. This is a pennant that breaks out into the buy zone. We're going to wait for a full bullish candle, okay, above the body above this line, okay, in the buy zone, okay, and breaks into the sell zone. We need a full bearish candle, full body into the sell zone. So when we're going north, full bullish in the buy zone. When it breaks to the south, we need a full bearish candle in the sell zone. That's the first step. Now, trading pennants before fundamental announcements, you can straddle. And there's a technique to straddle, and this can only be done before fundamental announcements. We put a buy order, just like we did on the consolidation. We put a buy order 15 pips above this high, and we put below this low, 10 pips below in the sell zone. And wherever the market breaks, we're going to take our profit. So if the market breaks north, this is going to be our buy. Our stop loss will be at the last low. This will be our last low. Here's where we put our stop loss, and we're breaking to the north. If the market breaks south, it activates this order. And it's going to be, remember, on large fundamental announcements, they're going to move the market. If it breaks to the south, then we put our stop loss above this high, and we're going to take this profit to the south. Now, you can straddle a pennant. You place your buy order 15 pips above. You place your sell order 10 pips below, and you wait till the break. So, for example, here, look, this would have taken us in. Okay, we put our order, this was before the fundamental announcement, 3 to 5 minutes before. You can go to forexfactory.com, or you could also go to FXCM's website, which is Daily FX, and look at all the fundamental announcements. And look how we have here, the market breaks into the south. It gives me a full bullish candle. It activated at 15 pips above. My stop loss would be 10 pips below this last low, right here, 10 pips below this last low. So if it breaks here, 10 pips below, I measure to make sure. And here, for example, here was 20 pips. It was about 25 to 30 pip risk. It's a good equity management. And you're going to see sometimes, I would say most of the time, the market breaks out, comes back to that backside of this trend line. It's going to be now this resistance line in the pennant. It's going to be now support, and the market bounces and then it rallies. So sometimes if you couldn't catch this break, well, in this case, you would have caught it because if you put that future order. But sometimes when it's a regular and you're not straddling, it gives you another chance, and the market rallies, and you could have bought right at that backside of the trend line. You buy it as near as possible, and you get even a better equity management. Okay, so my name is Vincent Luce with Forex Trading Institute, and I'll see you at the next lesson.